We are joined by Jason Buck and Corey Hoffstein, Pirates of
What's
Finance.
one of these days we're gonna get this live thing down. Once again, yeah. I'm obviously Jason. He's Corey. We got young Jack working the boards. Hopefully we'll be better on the audio and everything this week, and we'll progressively get better each time. Got to start out with two things always. Right at the jump. This is not financial advice. This is just for entertainment purposes only. Hopefully we do entertain. The second piece is for those of you watching the replay on your own leisure on YouTube. This is recorded live, so all the faults in the recording are my own. Actually, I'm gonna blame Jack. They're all Jack's fault, not mine. So hopefully, Corey will be the one to carry the program. Obviously this week has been a crazy week with everything going on in the Ukraine. Corey and I have no hot takes for you. We have no threads to participate in because we are not Ukrainian experts. It's been interesting to see, the people come out of the woodwork obviously on FinTwit about who's a Ukrainian expert. It's funny how people throw around a word like the Donbass, like they knew about what that meant 2 weeks ago. It's always interesting. It's like who read the news feed first, and then all of a sudden that's the potential expert. A lot of Dunning-Kruger effect or even Gelman amnesia. It's always fascinating to kind of watch what happens in these markets. But part of it, Corey, you and I, we run like total portfolio solution products. So it's always an interesting kind of like peace of mind example when these things happen to know if you've properly constructed your portfolio to how worried you are when you wake up to news or you wake up in the middle of the night and see that, Russia's, in the Ukraine. Trying to choose my words carefully about what that actually, in the Ukraine is, like it always gives us an example of how you position your portfolio. And then what we saw is, overnight that sell off, and you and I were talking about this previously, is that it's interesting that a lot of the actions happened overnight in the futures market, but like it doesn't really carry through the next day. So while we saw markets down overnight from the open and through the rest of the day, they just, stocks ripped higher. And so part of that is a lot of it can be due, a lot of, if you watch financial news, you'll get a lot of fundamental takes on why that happened. But more importantly, I think it's more, dealer positioning and degrossing. So I know, Corey, you had some charts you were looking at. So let's start there. Like what was going on with maybe, options market being the tail that wags the dog and dealer positioning, and then how that affected people having to, move their books around.
Sorry, guys. I'm gonna have to interrupt. We actually, this is a community. It may be 3 people on screen, but really it's a community of many people watching. We got Chris Sidiel saying, of course, Hoffstein has to humble brag with that shirt. What exactly do you think he meant by that, Corey?
I have no idea what he means. Maybe he's just jealous that I'm sitting in a nice tropical shirt on a Friday.
Exactly.
Afternoon.
I think Sidiel's just jealous that he's in New York, and it's the delta on the temperature. I was actually thinking about it, Corey, this morning, because as you know, I live in California, but this morning it's been in like the high 20s in the morning. I was thinking about the delta between you and me and the temperature wise.
Here's what I think it really is. Chris, when he shows up on camera, is always immaculately dressed.
Exactly.
I see very few people who can tie a tie as nicely as he does. And I used to do the same. I've given up. And maybe he's just jealous of where I've gotten to in life that I've accepted no more ties. I'm showing up on a Friday afternoon in a tropical shirt.
Corey, you have come a far way. Jason actually did share a photo of you with a tie, so maybe we can show that later.
Yeah. First of all, I want to say I'm very upset because I was not party to choosing who's like the pictures for the thumbnails of these videos, and Jason sent like these smoky-eyed, beautiful professional headshots, and he found the shittiest pictures of me he could find on the internet to use. So
those are my favorite pictures of you. Whenever I can find those ones from like your childhood or whatever, those are always my favorite. Corey was always not this glamorous and handsome. I just want everybody to know that.
I wasn't. First of all, thank you for that. But I will say, just a year ago, I was on Bloomberg with the grossest mustache anyone has ever seen. So we could pull that photo out if we want. All right, let's rewind. Let's go back to some of the hot takes here. So before I dive into maybe some of the charts and graphs we were having a conversation before we went live about, I think, sort of what the difference between being an investment manager and running an asset management firm actually is. I also want to say Jack got new software, and he is really enjoying throwing the screen around here, Jack. You're killing it.
Thanks, Corey. It is so much easier. I'm using so much easier, better software than I was the first time, which we had a few technical glitches the first time. It's a polite way to put it. So I want to give a huge shout out to the Blockworks production team for making the right call and giving me the right tools, and specifically Crystal Lee did a fantastic job for just making this as easy as possible. So yeah, we're gonna have we like to set a high bar here at Blockworks, Corey.
Crystal, thanks for making Jack look good. We appreciate it. So, okay, back to my point. So you sort of mentioned, Jason, this idea of running total portfolio solutions and what happens in markets. Maybe you are less affected by it because you're going to have that balance in your portfolio. You're trying to design something holistically to be resilient to no matter what the market throws at you. And that's true perhaps from an investment management perspective, but running an asset management firm isn't just about managing a portfolio. There's a huge component that is about client communication. And regardless of what's happening in your portfolio, whether you offer a total portfolio solution or you offer a more vertical strategy, communication is a huge part of what you do, either as a portfolio manager or just running an asset management firm. So we were talking, Jason, about on days like yesterday, what is the right course of action? Right? What do you do when the market opens down big and clients might start scratching their heads, whether those are individual investors, whether those are institutions, whether those are financial advisors investing on behalf of clients? You had some thoughts as to like how you've tried to structure things from a business perspective that I thought was insightful, sort of behind the scenes of what it's like running money. Curious as to your thoughts, how you think about client communication.
Well, I think every manager is unique, right? And your business is unique. And I think what we do, where we have kind of a blue ocean kind of in the hedge fund to fund space, where we accept retail money, and so we have a lot of clients. And so the question is like, how do you communicate to a lot of clients, right? You want to offer a bespoke service, right? It's all about customer communications and client service, and the experience of your product is really like, that level of communication. But when you have that many clients, it's hard to offer bespoke services. Like, so most hedge funds are going to have less than 99 clients. So it's understandable they have that one-on-one relationship. So you want to be able to communicate one-on-one, but you have to do it at scale. So the way we always think about it maybe is like, if we're going to reply to one client's question, we're going to reply to everybody. But it's also like, maybe that client's question is being asked and a lot of other clients have the same question. So it's like, you want to kind of cover that, because if somebody's raising their hand, which we appreciate, because otherwise, there's the silent majority. So you got to take those questions really seriously, because that means there's a lot of people not asking that question. And so the one we were talking about, maybe heuristics, is like, what's like the attachment points is like, after a negative 10% down move, then you report to clients. When markets start getting crazy, with the Ukraine situation, all that stuff is like, then do you report to clients? Like, that's typically when people want to kind of get an idea what's going on an intermonthly basis, if your communication's on a monthly basis. The other way I think about it is, Chronos versus Kairos. So in ancient Greek, clock time is Chronos, and then, when time speeds up, is Kairos. And so like, that's the other thing, is like, we happen in markets, there's long periods of stretches when nothing much is going on, where maybe that monthly cadence for like your newsletter or talking to clients works. And then you have those, time, when you have this Ukrainian invasion, then time speeds up. And then maybe those are the times when you really need to, do kind of a special issuance to kind of tell your clients where you're at. And so that was my perspective on it. What's your perspective on it? And yours is very different though, too, because you're running, very like 40 Act funds.
Yeah, and you have to be very careful with 40 Act funds. You can't selectively disclose positioning, which is a hard one. You obviously, and I think this would be true for you as well, any communication has to go through compliance. And if it's related specifically to a 40 Act fund, it not just has to go probably through your internal compliance, but it needs to make sure it's going to be sort of FINRA approved compliance. So for us, that means we have to put it through our fund administrators compliance group, which often can delay commentary significantly. So that's a whole other thought here, is you can't just say markets open, markets down 3%. I really need to write a commentary and push it out 30 minutes later. When you're talking about the 40 Act space, you might submit that commentary and not be able to send it out for 2 days. Or you might submit that commentary and you might get feedback from compliance that says, you can't say this, you need to reword it. And by the time you're ready to send it out, the market's moved on. It's 3 days later. So you have to be really thoughtful about the type of communication you want to do. And so writing broader thoughts, less specific to a fund, speaking in broad strokes, and sort of hoping investors can read between the lines can make your communication more timely, but less specific. And it's actually sort of a dilemma that fund managers face.
Part of that though, I'm curious to what you saw last couple of days is, for the most part, markets were very fluid. Like there's no like really leaps, jumps. Sometimes when time speeds up and these events happen, especially when you're in the option space, your marks and your bid ask start to blow out, and it's almost even hard with your third party admin to get an accurate estimate of where you're at. But we didn't really see that this week. I'm curious if you saw any of that on your options positions.
No, I mean, most of the stuff we work with is like the hyper liquid exchange traded stuff. So it was smooth for us. I haven't seen any large skips or jumps other than what we're seeing in the market, which I do think is unusual, right? Certainly this isn't March 2020 vol, but we are seeing some meaningful gaps in the S&P, which when you sort of take a step back and say, look, this is an index of 500 of some of the largest companies in the US as well as the world, large multinational, multi-trillion-dollar firms. Should we really expect their aggregate valuation, which is supposed to be based on the discounted future cash flow, going 5, 10, 15, 20 years out to whatever perpetuity valuation they have? Should that be changing by 6% in a week? Should it be gapping up 4% in a day? I think the fundamentals would certainly suggest no. So the question I think always becomes, okay, why is this stuff happening? Which maybe leads us back to your original question, which is yesterday we saw some really dynamic market action. Often when that happens, it is the role of commentators to come up with some excuse as to why that happened. I often find it ends up being a macro excuse that they felt more confident about what Biden said, or, investors went risk on, but it's never very specific. Like the who is never really said. And I think it's easy to just sort of paint with broad strokes, but if you start to try to identify the who, it gets a lot harder. And so for me, there were a couple of cases looking at the data yesterday that I thought there were maybe some specific who's that would lead to yesterday's price action. So I thought that might be sort of interesting to walk through, because I think potentially a lot of the flow yesterday was just a lot more technical and boring than maybe
it's always
people
boring
wanted to be.
Yeah, it never that doesn't make financial news though. Like, what's the classic Talebian one? Like they had put out like on the news that like markets were down because Saddam was captured, and then like 15 minutes later markets up because Saddam's captured or whatever.
Yeah.
Like it was like playing both sides of it. And I think like last week we purposely like did not want to give our hot takes about rate hikes. Right. And it was amazing to watch a few days ago how all of a sudden everybody that was, saying 9 rate hikes, all of a sudden that completely erased like 2 days ago, on Wednesday or Thursday. And then now they're back again though, so it's like how much that swung around in the last 2 weeks was phenomenal to watch people, jump and duck and dive on both sides of that. And just once again, trying to have a fundamental understanding of the future. And sorry, I didn't mean to digress. You can go back to like
No,
your
before
models.
we jump into the chart deck, someone actually asked a question about why is there regulation on communication? And again, I don't want to take for granted like people who are listening know this stuff, right?
Right.
I would presume a lot of people don't. So when you are an investment manager, there's certain different regulatory bodies you can fall under. You can fall under the SEC. You can fall under FINRA if you're managing a mutual fund or an ETF. You can fall under the NFA if you're trading commodity trading pool operator. And what happens is all of these governing bodies have different regulations as to how you can communicate to make sure, in theory, that it's fair and transparent and honest communication. So with someone like FINRA, for example, anytime you do communication that falls under FINRA's purview, you actually have to submit that communication to them, and a FINRA compliance officer will eventually review it and let you know whether they found anything that maybe wasn't as clear as it should be, or was a violation of their guidelines. So for example, if you quote performance, you have to have a table in your commentary that is a standardized performance table so that you can't cherry pick start and end dates. If it's going to be public communication, it needs to be written in a way that the expectation is your average investor could understand it. So communication for institutions can be more technical in detail. Communication for everyone else needs to be written in a much more transparent and friendly way. And often you'll see a glossary at the end. So when you learn these rules, when you manage money, you start to see it everywhere. So on a lot of websites of ETF sponsors or mutual fund companies, you'll see very long glossaries because that's required by FINRA. When you see fact sheets, you'll see everyone has the same type of performance table that shows 1 year, 3 year, 5 year, and since inception performance annualized versus their benchmarks, because you have to show that whenever you quote performance. That's the sort of stuff that is codified in the law. And it's just ideally to make sure there's a level, fair playing field in communication that's not going to be misleading to end investors.
That makes sense. So you don't have like a bearish fund give you their performance review from, September 2008 to March 2009, and stuff like that. Like someone's bullish gold, they can say, "Oh, well, over the past 20 years, do you know that gold has outperformed the S&P 500?" I don't think that's no longer true, but maybe it was in 2019. But that's because gold started a huge bull run right as the Nasdaq was crashing. So it's kind of cherry picked.
Yeah, and that isn't to say like you can't show performance over specific dates, but then you have to show the standardized table, right? There has to be that sort of like fair level amount of transparency in the communication. And again, like the regulations are ideally there to protect investors from bad actors.
But then we see on Twitter all the time is like people always want like you to give an opinion. And you're like, hedge funds literally cannot say anything publicly on Twitter. Like, and so they're like, just answer the question, jerk. And you're like, we can't. Like, it's
the same thing. Like when people ask about like tickers, right? Anyone managing money in a ETF or a mutual fund, which is called the 1940 Act vehicle, literally cannot comment on their own fund, because once they do, that's considered FINRA regulated marketing, and that has to be submitted to FINRA for their approval.
All right. Well, Corey, one thing I know is not regulated by FINRA is what I'm about to show you. And this is something where I really would like your opinion on it. Okay. And so we referred to this
segue.
We referred to this earlier where, I asked you guys, hey, we got to create a thumbnail. We got to put your faces on the thumbnail. Send us some stuff. Corey, you were away. You were traveling, doing whatever. So Jason took the liberty to share some photos, and he shared some of him.
I didn't do this. I didn't do this.
He shared some of you, and
Jack, this is how we're going to get a new producer.
This is also embarrassing for Jason, I think, because it shows Jason being vain. So this is the photo that this is one example of a photo that Jason showed us, and this is an example of another photo. So it's sort of like these are like model shots. Like you got, well, he had a photographer take it. He's steely eyed. These photos like this, you see. So Jason sent this immediately, and then this is what he sent for you, Corey.
Yeah. Thank you, Jason.
I was just waiting for the other photo.
All right, fine. All right, because you asked. This is the other photo.
I think
that's my favorite.
This must have been taken like right out of college. That looks like my college headshot or something.
Yeah.
Oh boy. Yeah, great. This is great content. Thank you guys.
All right.
I just want you to know I wasn't in on this at all. This is all Jack. Jack's just trying to get himself, like you said, a new producer role. So and
Jack's tired of the show already.
Yeah.
We'll and see. Jack, we promised you we wouldn't talk about your date last week, so now you might have set yourself up. So, but before we digress too much, Corey, we were actually trying to start to talk about at least 20 minutes ago here about
technical flow.
Dealer position. Yeah, technical flow.
All right, so let's pull up the chart book here. Let's go back a slide.
This is the one I think I want to start with. This is better than the first one because the first one's confusing.
The story, but you're going to tell this. Okay, cool. We'll start here. So here's the big story that I think a lot of people who have been watching markets over the last 2 or 3 years have really caught on to, which is the amount of options volume has gone up tremendously. And this graph, courtesy of Goldman Sachs, is just a 5-day rolling average of U.S. listed index and ETF put option volume in billion-dollar notional. So what you can see is like this number has climbed dramatically from 2021 and continues to climb in 2022, just suggesting perhaps a huge amount of put option protection being purchased. Now, it's hard to say what side of the street is on which side of the trade, and I know that's something Jason will bring up immediately here as sort of a gotcha to me, right? We don't know whether this is people selling puts because they think implied vol is elevated, or they're trying to structure a bullish trade. We don't know whether this is part of a bigger position, or whether maybe they're buying synthetic exposure, buying puts and calls, or selling the puts and buying the calls, or we don't know whether they're actually trying to buy protection. But what we do see is a large amount of put option volume, and the color that at least I'm seeing from the sell side is a lot of this is the buy side buying options, which just suggests potentially there's a lot of people who are positioned in a hedged manner today versus say early 2020. Jason, agree? Disagree?
No, I'm gonna let you talk. I'm gonna let you get it out. I was
All
just
right.
thinking while we were watching is like if you could take out JPM hedged equity, like how much of that is, and then I'm also just looking at the spikes and everything is like how we saw that Q4 of last year protection, and then people maybe rolled out of that in January, like were they repositioning again this week? And I think you're gonna get to that.
Yeah. So you want to go on to the next slide, Jack?
Yeah, this one.
Yeah, so the other big sort of narrative that goes along with all this new option flow is about what's called dealer gamma, right? Which is if you have customers buying or selling options, there's a counterparty to that trade. In many cases, that's going to be an option dealer, and their goal is not to have net long or short exposure to those options. They don't actually have a structural or directional view. They don't necessarily want to warehouse risk, and so they're going to try to hedge their exposure. And so they need to buy and sell the underlying stock or index. One of the things you see is that when this number is very positive, this estimate of how much they have to hedge, what it typically means is when the market's going up, they have to sell a little of the market short, and when the market's going down, they have to buy a little. So it's a sort of a negative feedback loop in a way that is helping keep the market stable. When the market moves dramatically, it can push dealers into what's called the sort of negative gamma zone, which means that their hedging behavior now becomes pro-cyclical. So when the market starts to go up, they will buy more. When the market starts to go down, they will sell more. And in theory, this can push the market further, faster, because it's a whole lot of billions of dollars chasing index and underlying moves. Now, is this predictive of direction? Historically, at least when you look at the numbers, no. It tends to be coincidental at the very least that higher realized volatility occurs when in these negative dealer gamma zones, and lower realized market volatility tends to occur when dealer gamma is much higher. So going into this week, what we have seen is dealer gamma has been negative, which is suggestive that dealers might be chasing price action. Market's going up, they're buying, market's going down, selling. And so our expectation may be conditional on that information, just a much higher potential for intraday volatility.
I just want to reiterate what Corey said, just to make it simply too, is like when dealer gamma is positive, you tend to have kind of a mean reversion effect on markets. And when dealer gamma is negative, you can kind of explode, in either direction is the way to think about it. But the other thing, like you said, this is very probabilistic, right? This is just giving us an idea of a picture, what can potentially affect markets a little bit. But the hard part is like, it's, 70% of the time it works all the time. But also, I mean, shout out to people that like try to build these models. It's not easy. And then you also have dark pools. And so like, shout out to Squeezy for like trying to figure this all out. But it just gives us a general kind of framework for probabilistic thinking. It doesn't tell us exactly which way, directionally the market's going to move.
Yeah, this number, by the way, is like, this is one of those cases of a model where I say like maybe directionally right and precisely wrong. Like you can't look at this number and say it's correct. There's a comment here about like, isn't this graph made under massive assumptions? This one is from Goldman Sachs. There's a lot of graphs out there. Again, they all sort of like correlate pretty well with each other, but they all have different assumptions about, who's on which side of the trade. This is from Goldman Sachs. I do believe they have models that are trying to figure out whether someone is on the buy side buying or selling an option to better track. So for example, they don't just assume every call option is being sold short and every put option is being bought long by the buy side. They are actually trying to figure out whether someone is crossing the bid or the ask to adjust that position. But again, like the number doesn't matter so much as, is it meaningfully positive? Is it meaningfully negative? When you start to get to those extremes, the assumptions wash out a little, but there are some absolutely subtle nuances that make this number precisely incorrect.
So Jason, you said, my audio's on. So you guys said, just to break this down, but I want to go an even a step further back, which is that options is like the right to the right but not the obligation to buy or sell something, the way to get leverage exposure, to get exposure to volatility. And this is options on put options, so the right to sell. If you're buying it, it's bearish or negative delta on U.S. listed index and ETF. So that would be on like S&P 500, SPX. It would be on SPY. It could be on XLI, the industrials ETF. It could be on a biotech thing. It could be on any sort of thing, but not single stock. My question, maybe I'll direct this at Corey, is why is it going up? Why? Who are buying all these options? I've heard a lot about, oh my God, everyone's buying retail investors. They're buying Tesla options. They're buying Apple options, but that's single stock. Who are the people who are buying puts? Go ahead.
Two things on that. One, yes, I should have brought a chart for you too. That's been interesting. That's seeing like single stock option volumes actually down, especially on that call side in the last few months, because like how many people were paying up for their YOLO calls in tech stocks and then just got burned. And so maybe they're kind of backing away from the markets a little bit. But also, as you're saying, with this chart, this is for the listed indexes. And so that's why I referenced the JPM hedge equity. Like how much of this is just collar positions, right? Where you're selling the call and buying the put. And that's what's really moving the market.
Buying the put spread. Yeah, there's a comment here, someone asking how much of this notional, right, is actually just due to the market going up. Yeah, as the market goes up, if people want to buy the same amount of notional coverage as a percent of their holdings, they need to buy a larger dollar number. So there is some of that effect here. It certainly doesn't account for the fact that this has gone up like almost 300% in the last 2 years. So there's certainly more option activity, but you're seeing a huge amount of structured product sales happening in the US now in the last year. You're seeing a lot of those style of products become very popular in ETFs and mutual funds. So buffered note style products, right? The JP Morgan Hedged Equity Fund is a very large and famous one that I think tripled in assets over the last couple of years. Innovator ETFs has done something very similar. There's just been a much broader adoption of these sort of option style strategies in 40 Act wrappers. And then I think a lot of people post 2020 introduced the ability to utilize options as a hedging vehicle or mechanism within their own accounts, either institutionally or what have you. So I just think there's been a lot more appetite for this post March 2020, and that's driving a lot of it.
When you point out something that I want to highlight too is like structured products. So shout out to Sidiel. He's probably long gone, but Sidiel is also always pointing out that the rise of structured products in the US is phenomenal, right? And usually that was always an Asian and European thing. And now we're seeing like US kind of structured products are outpacing that. And that's part of like going out that yield curve. And that's what we're saying, maybe the options market's the tail that wags the dog because people are looking for yield. And this is the only way they can go out the risk curve and find, some sort of leverage. Was interesting this week. I was actually reading a lot about 90 structured products in Japan. It was, market down 80%, real estate down, interest rates at zero. I'm not going to say that presages what we're about to go through because very different timeframes, very different countries. But it's always interesting to think about like all the crazy products they had to like basically like fleece retail. Right. Even though it's like the retail banks and they're selling it when anybody comes in with a deposit and they're like, hey, if 0% yield here in government bonds, I can get you 6%. And they're like, great, sign me up, not knowing the risk that they're taking. And that's what the structured products do is like, and I love how the names change over time. Like, Corey, have you ever heard Embedo?
No.
So that's originally structured products were called Embedo because it was a bond embedded with derivatives. And so like you have all these Embedo. And then when these things were like rising in Japan for yield, especially in the 90s, it was a lot of, like dual currency kind of, spreads and options and everything. And they had all these because they had a golf vacation bond was one where like you got paid in Aussie dollar interest rates. So when they were saying that would pay for your golf trip when you went down to Australia. And then they had even corridor structured products where as long as the interest rate stayed between like 3% and 6%, like you were fine, but like, and then, but then it broke out. So instead of calling it corridor bonds, they call them fairway bonds, like for the golfers in Japan.
Marketing.
Very clever.
Is why we have regulations, folks.
Exactly. It was also another one I liked was, I hadn't heard this before. You have worst ofs where like you can have the worst, and if at any point Apple, Tesla, Microsoft is down 25%, you'll take the worst of, which if anyone touches that, you get knocked in and you get screwed on your structured product. But they were called like 4 rainbows. If you had like a four spread worst of, it was just great reading about all this stuff, but also seeing like the parallels of like how the names change, the players change, but nothing else really changes. It's like almost like, it's an eternal recurrence.
There's some dual currency products definitely in crypto for sure. Also, yeah, when you say knocked in or knocked out, is that referring to sort of a binary bet where it's you don't lose money like this, you lose money like this, like it's like a corner? Yeah,
you make 6% yield, let's just say, until one of your worst of markets is down 30%, and then you're down 30%. So you get
all the risk.
So it's like you have no risk until you have all the risk. But what's even more interesting that makes those hedges really difficult for the banks that are putting those on. And so it also has like this really interesting kind of hedging curve. As it gets towards that barrier of that worst of, they're hedging more and more of their exposure. So their hedging is rising. But then as soon as you get that absorbing barrier, they need to take off those hedges. So it's almost like they're hedging, if they're front running it getting to that point, which can also exacerbate the move. So it's very hard to hedge those. And like, you start getting into, especially the dual currency ones, or, you start using forwards that don't exist, and you have Bermuda options. Like it's a nightmare to hedge these products.
You want to jump back to what? Yes, I agree with all that. By the way, Jason, it was a good tangent to go on, because those products are insane. And actually, like in grad school, a lot of our homework was around like building out those products and trying to hedge them. And those rainbow products you mentioned, those like worst of baskets where you knock in, are just, I mean, to your point, like they're a hedging disaster. It's incredibly dynamic. You're keeping track of multiple positions, and right at the end, everyone needs to rip it off. And so a lot of like the commentary in March was around the impact of those style of structures. Ben Eifert, I think, had a great podcast with Bloomberg Odd Lots around that time, where he talked a lot about that, if people are interested in learning more. So let's dial it back into the chart deck, which is, okay, what happened potentially yesterday. And this is a graph from Spot Gamma. It's called their Hero Indicator. Don't ask me what Hero stands for. I can't remember. Basically, what you're seeing in the black line is the price of the S&P 500 intraday, and then cumulative delta exposure change for dealers for call options in the orange and put options in the blue. And the idea here is basically, if people were buying a lot of calls, you'd see that orange line go up. If people are buying selling a lot of puts, you would see the blue line go up. And so what you see is, yesterday you didn't get a lot of call buying. There seemed to be a tremendous amount of put selling. And so one of the things you might see in an environment like this is what we would call like a risk clearance day, which is a lot of people had bought hedges for a Russia-Ukraine event, short-term hedges, and it becomes a buy the rumor, sell the news. The market takes an unknown, uncertain future. Suddenly it becomes a realized reality. The market reacts, and people monetize their hedges. And in selling the puts they owned, dealers would then unwind their positions, forcing them to buy back stock. So it ends up, when people monetize their puts, it's implicitly them saying, get me out of my short. I want to be neutral to the market again, which means I have to buy back the underlying, which drives the price up. What you also see, at least I believe in theory, is you would see implied vols in the puts go down as people start selling their puts, right? And so that would, in theory, potentially create some sort of like second order Vanna effect in the delta as well. But the big point here is, like, what seemed to happen yesterday was a bunch of people monetize their hedges, and that just, from a technical perspective, created a lot of buying in the underlying. It's nothing sexier than that, potentially.
Yes. So you're saying that people bought hedges via puts, and that meant that the people who sold on the puts, someone asked questions, for every buyer there has to be a seller. But if it's like a one directional market, whereas people, when you buy a put option, you're not necessarily buying it from some other person who had that put option. You're buying, it's kind of like you're buying insurance with a market maker, and the market maker is just creating that product from nothing, the put. So then they are short a put, which means that if the price goes down, they lose money. So they have to buy the stock in order to hedge that risk. And when you sell them back the put, I got lost, Corey.
They have to short the stock to hedge their risk, right?
Yeah. They have to short the stock to hedge that risk.
The easiest way to think of it, right, is if like you're just passing through the position you want. So when you buy a put, you're basically saying as the market goes down, I want to be more short, but I don't actually want to go through the actual exercise of shorting. And so what happens is by buying the put, you are in theory forcing the dealer to do that, the person on the other side of the trade. So you're just passing through your implicit short. And then when you sell your put, you unwind that short, which means you have to buy back the position. In this case, you're not buying it back. You just, in selling your put, the dealer's buying it back. And so if everyone was buying all these puts, short-term protection, and then this big risk event happens, right? And you get this risk clearing type of day where people go, okay, it's time for me to monetize my puts because I was buying as a hedge to this Russia-Ukraine event. It has now become an uncertainty to a reality. In selling the put protection that they had and monetizing their hedges, they're implicitly saying, buy me back all the shorts I had. And so in buying back the shorts, it's just creating positive demand.
Okay, that makes sense. And that makes sense about why did you have a huge spike in the S&P 500 that started yesterday and continued today. How about, Corey, the composition of the rally, the fact that it was, the most shorted stocks? We can go on to this next chart. The stocks that have been the year to down the most expensive software, think ARK, the most shorted stocks, the most stocks with this sensitivity to Bitcoin, sort of the high beta, which is a way to put it. That is the stuff that rallied the most. And you had stocks like Lemonade had what was thought to be a bad quarter, what the media called a bad quarter, because the stock went down 22% Wednesday night going into after hours. But by Thursday end of close at 4 p.m., Lemonade was actually up on the day. So it rallied like 22% in a single day. So why was it that the sort of, for lack of a better term, junky, the more expensive software, why was it that part of the market was the thing that went up?
Yeah, and again, like this is not when Jack asks, why is it? This is just me speculating, right? It's like a potential technical answer versus what I think you would typically hear is, well, people became risk on. Maybe, again, they liked what Biden said. They liked, for whatever reason, and they wanted to own high beta stuff. Another potential answer is there's a large amount of strategies and funds out there that hold both long and short positions. So they might be long, high quality, strong balance sheet stocks with good earnings fundamentals, and they might be short a lot of these junkier, overvalued, non-profitable tech names, for example. One of the things you saw yesterday is like the most shorted baskets, and you can sort of get these baskets from sell side like JP Morgan or Goldman Sachs. They put them together. Was some of the baskets that were up the most yesterday, which means the most shorted stuff potentially got squeezed higher. Well, why does that happen? Why do you see the overall markets up, hedge fund sort of VIP names, they're long or underperforming, and the stuff that they're shorting is outperforming? Well, a lot of that tends to happen because of what we would call a degrossing, right? That if they are 200% long and using leverage, and the risk manager comes over and says, hey, you got to sort of tighten up the book, there's too much vol. Well, what they're going to have to do is buy back their shorts and sell down their longs. And so what you would ultimately end up seeing is selling pressure in the longs, buying pressure in the shorts. If everyone in the street is crowded in those names, it would lead to some pretty significant dispersion. So again, like it's not necessarily some they or retail or anyone like that is all of a sudden bullish on these names, whereas because of a Russia-Ukraine event, it can be very simply answered with like some technical rules of, hey, market vol went up over the last couple of weeks. You hit some risk limits. You need to degross, and that degrossing, based on the types of positioning we're seeing among sort of hedge funds, explains a whole lot of it.
I don't know. I think. Yeah, go ahead.
Go ahead, Jack.
I was going to say, I don't think that, Corey, I don't think that's right. I think it was, Boris Johnson said that we got to focus on renewables and decrease our dependence on Russian, plutocratic, kleptocratic energy and gas. I think that was responsible for all of the market's moves. Corey, you actually, seriously though, you someone in the comments, Commander Korn, touched on a point, said, isn't this just like a short squeeze, except a manual unwind instead of a margin call? Based on what you're saying, Corey, it sounds like the answer is yes, although that margin call was not initiated by a broker. It was initiated by the risk manager with the proverbial tap on the shoulder of the trader.
Yeah, and there may have been more explicit short squeezes here. There may have been more explicit, hey, they did get a real margin call. But it may not have been. It may have just been the risk officer. I apologize for my lighting right now. I'm getting significant.
This is the best humble brag I've ever seen. Is that Caribbean lights just filtering through and shining a halo over you?
Yeah, let's keep this on Jason the whole time. I honestly have no idea which way to tilt my camera to avoid this.
But Corey, what you're talking about, what's interesting to me is like this was like a mini version of what you and I talked a lot about in March of 2020 of just like endogenous events, right? Everybody wants to ascribe these things to exogenous events like Ukraine or COVID, but like March 2020, we had a lot of endogenous events with what we call degrossing or de-risking of books, like across the board, especially as vol picks up, people are vol targeting and they might, get that tap on the shoulder and they need to degross or delever. And then part of that too was the idea that you showed originally about like dealer positioning and everything. And shout out to Jem Carson. He talked a lot about, when OPEX came around, that was when we saw the bottom of the market. And so once again, it's about like dealer positioning as well. But is your paper Liquidity Cascades is like, those are two of maybe 5 to 8 different phenomenons that kind of like can cascade together. Is that a fair assessment?
Yeah, I think a lot of what my paper back then was about, and a lot of just what I'm trying to stress here is like, there's sometimes just purely technical buying and selling pressures in the market that are not someone expressing some massive macro view all of a sudden or some mysterious they doing anything. I think a lot of the day-to-day movement in the market is, hey, I got some cash flow in, someone subscribed to my fund, some private client, had a acquisition, they now have cash, they're putting it to work in the market. Like money comes in and out of the market for so many reasons that are not someone expressing a view. And a lot of the buying and selling that happens day to day very often is technical. I mean, one of the things you start to hear from older traders is like, they look at the tape and they go, this feels like someone blew up, right? And you sort of like got that impression with Bill Huang. I mean, I apologize if I am mispronouncing his last name, but like there were people saying something's very wrong. Positions aren't moving like they're supposed to. This is the type of stuff that happens when someone out there blew up. And it's not always the case, but I think knowing how markets are supposed to normally behave and then seeing them misbehave is normally not a sign that like the market is just doing a massive fundamental repricing necessarily, but often a sign that someone was caught off sides and is now a forced liquidator or forced buyer of some capacity.
I'm going to kind of go against everything we just said. So I'm curious as like, we're not discretionary traders, so we don't go by our gut. Like you said, people have gut feel for what's going on in the markets. But I do remember and by the way, I'm like a broken clock. I'm never right. But I do remember having the feeling before markets opened the other day that like the futures only being down a little over 2% on the SPX futures, or on the S&P futures. It just felt like the market was like surprisingly robust given the news. And then obviously it took off after that. But I was just curious how like any feelings like you kind of had going in after like the overnight move, and not that either of us are discretionary in any way.
Feelings I had. Well, one of the things I saw when the market had last touched the same sort of level, right? So if you rewind the clock 2 weeks ago, 3 weeks ago, when the market, I'm just pulling up a chart. So when the market hit like, I'm talking about the S&P here, end of January 24th, when the market went down to like 4,200-ish area, one of the things you saw was a lot of put selling. So again, like my expectation was we're hitting the same area. I wouldn't be surprised if people who missed their monetization opportunity then are looking to monetize now, right? Because at least I know for myself, there were suddenly hedges that were non-profitable, a couple hundred points higher, that were suddenly, up hundreds of percent. And if there are people like me looking to potentially monetize and they monetize in mass, well, it can sort of become a race, right? Because especially where options can lose and change their value so quickly, once people start monetizing, and if the market starts going up, then other people are going to rush to monetize, and sort of that rush for the exit that creates potentially this buying frenzy in the underlying.
One of the things you also brought up is kind of like rotation, or part of degrossing is maybe sometimes rotation. You and I actually haven't talked about this privately, so I'm curious your take. Is like this rotation you get from growth to value or momentum to value, and like we saw a violent one. Was it Q4 of 2020? We're starting to see that in the last few months. I'm just curious if you have a hot take on that, or you just think we'll see.
This is one I am sort of like constantly scratching my head about, because cross-sectional factor volatility. So the volatility of like the value factor versus momentum versus small caps versus defensive, like high quality, low vol, has remained really elevated. Abnormally so. You typically see it spike during a crisis, and a lot of that's because people are repositioning really violently, often because they're forced to. So you see huge spikes in like cross-sectional factor performance in environments like 2008, and then it rapidly decays as markets stabilize. One of the things you saw in March 2020 was the very typical pattern, and then it stayed very abnormally elevated. So it has sort of stayed in a region that is, if you look at cross-sectional factor vol from say 2012 to 2020, we have stayed above the highest level cross-sectional vol hit over that entire 8-year period since March 2020 happened. So what does that say to me? It says to me that like markets cross-sectionally, like within the market itself, still remains very unstable. People are still sorting through positions in a very violent manner. They're repositioning, maybe they're degrossing, getting margin calls. So it's hard for me to read into like short-term relative performance plays, because that short-term relative performance has been so much more volatile than it has in the past. For it to be sort of statistically significant, it needs to move further nowadays, right? So I don't really know. I mean, when you look at positioning, you've definitely seen like in mutual funds, the stats are, for example, like mutual fund managers are net underweight the FANG names, max underweight they've ever been over the last 10 years. I just saw that stat the other day. Maximum positioning into cyclicals, huge relative positioning into value versus growth. So you've seen a lot of the money move already. You know, I don't know what it will take for this value move to be sustained further.
I love when I get to front run Jack, because I know he's got a question when he pops on screen and I get a Dark Vader deep breath on his mic.
Yeah.
And I'm like,
Jack, you need to just pop in when you're ready.
You go, Jason. You go.
No, I was just commenting on your breathing that I get to catch every time you're ready to ask.
Oh yeah, but Jason, if I pop in, I'd interrupt you. So I gotta, I want to.
Yeah.
I want to hover, which is clear that I'm glad that Jason is noticing that I'm hovering. Corey, so I'm, maybe some people watching are in the same boat as me. Sounds like we do have a few, very experienced finance people based on the comments in terms of sophistication. But I know what a factor is, like growth versus value, size, Apple versus a small cap stock that in the Russell 2000. When you say cross-sectional volatility, is that the rate at which there's a rotation out of growth into value, out of small caps into big? Is that what you're talking about?
Yeah, so I'm just looking at like how are the factors performing relative to each other, right? When you look at the momentum factor, how is it performing relative to value? There is expected to be a difference, right? They're holding different baskets of stocks. But one of the things you see is that the relative performance dispersion between them on a day-to-day basis is now much, much, much higher, right? And let's keep this very simple. You look at growth versus value on a daily basis. Maybe back in the mid 2010s, you expected a 10 to 15 basis point move every day between them. We are now very consistently seeing 80, 90 basis point moves between them, right? And that's the type of behavior you definitely see during a crisis, because often one of those baskets has all the names that the real crisis is happening in, and everyone's fleeing to safety and all sorts of other repositioning that's happening. You don't tend to see it prolonged at elevated levels after a crisis, and it continues to be very elevated, abnormally so. And so to me, I don't have a good answer for this. I just find it to be a very unusual statistic that at least suggests like the market positioning still remains very uncertain and unstable.
I think you guys are going to think that I'm just like a macro person, relating everything back to the Fed. But I think of growth versus value is kind of a proxy for duration, which is in some ways, poorly defined mathematically. But like it's the reason that a company, a value stock, is cheap is because it's not going to grow. And therefore in 30 years, its earnings will be, or 10 years, its earnings will be somewhat similar to what it is now. Whereas Tesla, I think even bears would agree, like revenue in 10 years is going to be substantially higher than it is now. So that's a question of duration. And that's based on discounted cash flows, based on the discount rate. And you've had tons of, volatility in interest rates. So when you have the 10-year, going from 1.4% to 2%, I think that can be responsible. And in between, not only is it going there, but path dependence, like every single day it's going. I think it's not surprising that you see some amount of that represented in growth to value. Jason, what do you think of that? Am I full of my macro narrative?
No, I love this because like this is a common thing that people are talking about. And so I was actually thinking about this on my walk this morning, and I was going to ask Corey privately, but so this is great. I'm glad you brought it up. I always love this, like it's a duration issue, right? And then they're talking about like these tech stocks will get hammered on duration as interest rate rise because they're like long duration or infinite duration assets. And I was thinking about on the walk, I was like, one, forgive my naivete on DCF. I'm not a fan of DCFs because I've actually run businesses. So thinking you could project your cash flows out 10 years is nonsensical to me. But part of that is idea of duration. Like you just said, it was at 1.4 to 2. Let's say it goes from 1 to 5. But like, let's say Tesla or we shouldn't say Tesla. Pick like Amazon, Microsoft's of the world. If they can compound at 20 to 30%, how does that fucking matter? Like that's what I'm curious about is like, so even if it goes from 1.5 to 2, how is that going to affect their cost of capital when they're compounding at 20 to 30% annualized?
It doesn't impact their cost of their cost of debt, really. I mean, they don't really use that much debt, although they have, like, they don't need to. But a cost of equity, let's say you're right. If you're an actual business owner, which I've never been, it doesn't impact, like, who cares about 1.8 versus 1.9? Let's say you're right, and I think you are actually. But like portfolio managers agree with me, and I can show you because every single day that interest rates rise, that's a day when ARK is probably down.
Yeah,
so
you're right. It's a
market's on
Keynesian,
my side, Jason.
It's a Keynesian beauty contest, right? And everybody's going to now DCF chop these in half, and I'm like, it just doesn't make sense to me. But maybe Corey will have a more nuanced approach.
Well, I will just say that if you were to actually run the analysis of value versus growth and the sensitivity to interest rate changes from 2010 to 2020, what you would find is that growth has almost no sensitivity to duration changes, and that a lot of the sensitivity is actually in value. And most of that really comes from the fact that when you look at value stocks, the way the index is traditionally built, if you just use something like price to book, and you don't exclude financials, you just end up with a bunch of financials. And financials are obviously very sensitive to changes in interest rates. So if you look at super naive indices, it ends up looking like growth versus value as a trade is very duration sensitive. If you drill into it, well, it's really not growth that's duration sensitive. It's actually value. Now, Jack, to your point, all of a sudden this narrative has propagated. I think it makes sense theoretically, right? And this idea of a stock's duration has been out there for a long time. It doesn't seem to play out in the data over the last decade, but that doesn't mean it won't play out going forward, in the sense that a lot of what is true in markets is what the participants believe is true. And if everyone believes that interest rates are going up and that growth names are high duration trades, and everyone rotates out of growth names, well, then it becomes true. So who really cares whether it was true or whether it should be true? It just becomes true. And so it's like, to me, a really nuanced debate, because I don't think the data quantitatively supports it historically. But I think you have seen the correlation go up dramatically, and it's a question of, is that causal? Is that true repricing of cash flow that's happening, or does it just happen to be a spurious correlation?
Speaking of spurious correlations, I want to get to one more thing before we have to sign off here, is like the idea too of, EM is coming back in vogue, emerging markets, right? And it's been out of vogue for well over a decade. But part of that, I would say, part of that narrative and vogueness is the idea that commodities have been ripping higher and continue to rip higher, and so it's more of like people that are pro that inflation is here to stay are then looking at commodity currencies or commodity economies, and they're looking at emerging market stock market, and then they're looking for maybe that rotation from the U.S. back to emerging that we've seen once again historically, even though that's not a very large data set, I would argue. But Corey, you pointed out a chart by Julian Brigden. Shout out to Julian Brigden, by the way, the best presenter I've seen live in my entire life. He's unbelievable. But Corey, I get this. Jack will pull up the chart, and you can kind of talk through like what you were saying on Twitter with Julian's chart as far as like US versus EM.
Yeah, and I want to be really clear. This is not meant to be dragging Julian in any way. This is one of my little pet peeves that I picked up on, and I'm sure he maybe has a lot of other good reasons for his investment view here. I just think the one he laid out wasn't all that great myself. So he posts this chart, and his tweet says, "I understand that inertia is a powerful force, but I find it amazing that investors still think that U.S. stocks are the place to be invested and will continue to outperform the rest of the world. I, for one, don't take 5 standard deviation trends, 1 in 1 million bets." And he shows a price chart, the relative price performance of MSCI World ex-US versus MSCI US, and he shows that from a price spread perspective, the relative spread is at a 5 standard deviation event. I should point out, these are price returns, first of all, not total returns. So he's totally ignoring the impact of dividends in both of these. But that is like the lowest of my gripes here. My big gripe when I see charts like this, especially like US versus international or EM, when you're making these really big relative regional bets, there's a huge amount of unintended bet that gets baked into it, right? So let's say I believe this, which I'll get into why you shouldn't, but I believe this and I buy World X US. Well, you are now suddenly taking on huge currency risk, right? US dollar has now become one of your implicit bets. You are taking on geopolitical risk. You're taking on explicit geographic risk. You are now adopting a very different sector weighting scheme, World X US versus the US. You're taking on different legal risk. So there's all these risks that get baked in, and that isn't to say this isn't a trade you can make, but the point is when you're making a big regional shift in your portfolio to say, I want to be out of the US and buy everything ex-US, there's a huge number of bets that you need to consider that you're now implicitly making. Now, why don't I think this in particular is a good reason to take a bet, the relative price dispersion? Well, the answer is, at least to me very trivially, that you wouldn't expect there to necessarily be a reversion in price, right? If these prices were driven by fundamental growth, that the US truly outgrew the rest of the world over this period, why would there be a price reversion? If you said to me the US is relatively overvalued versus the rest of the world, right? That our price to our fundamentals is much higher than the price to fundamentals of foreign developed, and that's at a 5 standard deviation, maybe we can start to talk and take into account all the other factors we have to consider. But here there's no reason that relative price movements ever need to come back in line if those relative price movements were originally justified by changes in fundamentals. Price itself is not a driver, particularly over the long term, of reversion in a relationship like this.
That's right. I was thinking about going back to those 90 structured products in Japan, is like they were, where they were getting like a 6% interest rate, but they got smoked on the currency pair, right? It's always about, what's going to happen to the FX, pair relationship that you're carrying. And I think about it often, man, there's nothing more heartbreaking than talking to like an emerging market manager that was up like 25% on the year, but the dollar took off, so they're actually down 30% on the FX trade. So net they're down 5%. It's just heartbreaking.
I mean, think of any EM manager who was buying Russia as an oil trade with a dividend, and then suddenly got smacked with massive geopolitical risk. Now, I would argue you probably should have been hedging some of that, right? But people have played Russia as an oil trade for a long time. That one came back to haunt them because they ended up taking a huge unintended bet, right, in buying that country. Now, this is not to say, this is not like you should only buy US equities. That's not at all what I'm saying. I'm just saying if you are going to be taking huge tactical bets like this, US versus international developed versus EM, you really need to consider the foundation for those bets. And in my opinion, because there's so many unintended bets baked into it, the foundation should be at such extremes, right? Relative valuations need to be at such extremes between US and foreign developed for me to even consider a large tactical bet, because I want it to be so overwhelming that it can't just be the noise from all the unintended bets I'm taking.
Fair. And inquiring mind want to know, and by inquiring minds I mean Jack, what are your weekend plans in the Caribbean there? I mean, are you just going around on your yacht all day? I mean, you're just looking for a safe harbor?
Are you talking to me?
Yeah.
Ironically, I actually am going out on a boat tomorrow. I have to tell you, I'll disclose to the audience. I am currently in St. Bart's. A friend is
I didn't
getting
want to
married.
dox you.
A friend is getting married. That's why I'm here. And I have never felt poorer in my life than being on this island. The mega yachts that are anchored off of St. Bart's and going to dinner every night, literally everyone around you is buying the most obnoxious bottle service and these like massive gold champagne bottles. And it's just like these multi-billionaires. I literally watched someone go from a restaurant, get in a little rubber dinghy, drive out into the water, maybe 50 yards to get on a 55-foot boat that then took them to their yacht.
Wasn't this this is like, I think it was part of like Hugh Hendry's global macro bet on St. Bart's or something like
Yes.
the effect of like, you need an island like St. Bart's where the rich can come and really flex their wealth, because there's not like anybody to really like shit on them for doing so. And like, so you need places like that. They just explode in value because it's just a place where people can really flex at the highest level and not feel bad about it.
Yeah, I looked at real estate just out of curiosity, and it was like perverse curiosity. I mean, real estate around here is just insane. Now, it's gorgeous. Don't get me wrong. It is beautiful. But it definitely makes you realize how much wealth there is in the world and the wealth disparity among people to come to an island like this and just see the amount of wealth that is being flexed.
Corey, would you say that the real estate appreciation in St. Bart's, is that captured in the CPI?
The global CPI?
or US, yes, or St. Bart. They have a CPI probably. I don't know.
You know, I haven't checked the St. Bart's CPI.
That's not the first chart you look at every morning.
No, it's not.
Fair. Well, but yeah, before we close, I want to say, Julian, Brigden, it's interesting your take, Corey, and I definitely hear what you're saying. I will note though, in the macro world, I don't think there's anyone who has just nailed every single turn over the past 2 years more than Julian. Like, he nailed getting long commodities in November of 2020. He nailed shorting the front end when, like, I remember when he first said that in a year ago, and I was like, Julian, what? And of course, that was like the ultimate trade. Being skeptical of the growth stocks as well. So, and definitely, it's like I know what you mean. You're a very rigorous quant, so you're saying, Julian, you're kind of going into my lane here, talking about standard deviations, and I know what you mean, because sometimes I'll see like a technical analyst talking about like moving averages, and then they'll start talking about the Fed and the Fed's balance sheet, and it may not be as precise, but like those people make money, and Julian can still be not as precise and like make good calls.
Yeah, I think the point is though, like, you can be not as precise, and he might have very good other reasons to invest outside the U.S. I've heard some very good arguments as to why you might want to take your money and make a big tactical bet outside the U.S. My point is, and this is something I will definitely argue, that is a terrible reason, the one he pointed out. Price spread, and to get more technical, and I see Michael Harris putting it in the chat, when there's no unit root between the prices, when there's no expectation that these things should ever move together and that the difference should converge for any reason, it's not justifiable from any investment framework. So I'm happy to have an argument with him about it. He may have a dozen great reasons. And by the way, his call may be correct, but you can be correct in markets for the wrong reason, and still make a bad call. So anyway. No insult to Julian. I don't know his work well enough, but that was one of my particular pet peeves when I see people make this type of call.
Gotcha. Well, I like the segment pet peeves. I think it was on the last show where my pet peeve was like people talking about interest rate credit spreads when they're really talking about interest rate risk. Jason, you want, close us out on a good note. What are you doing this weekend?
Well, can I just say, if we do pet peeves, by the way, it'll just become the Jason show.
Oh yeah.
I was gonna say I didn't know that. I thought the entire show was pet peeves. I didn't know like we actually had anything positive or optimistic to say. Although I did start our initial chat with that great quote. I can't even remember who said it at this point though. That like pessimists sound smart, but optimists make money. Unfortunately, Jack, I don't have a great a weekend story for you because I'm really boring. I literally enjoy the weekends for the quietness so I can get more work done and do more R&D. So I spend my weekends reading everything I can from the time I get up till the time I go to bed usually. But other than that, I got to run to the airport. So I'm going to have to sign off with you fellas. But
cool.
We appreciate everybody watching, whether it's live or on the replay, especially live. We really appreciate it. We appreciate all the comments. Once again, this is not investment advice. Do your own due diligence. Anything else, Corey?
Yeah, real quick. I like that you called you like reading a book on the weekend. I like you call that R&D. You think of yourself as like a corporation, research and development.
He expenses it as well.
Yeah,
exactly.
Yeah. There we go. I would just note, if you hope you like this show, we will be doing this, rain or shine, wherever Corey is, every Friday at 3 p.m. Eastern time. And to get notified, you got to subscribe to the Blockworks YouTube channel. Follow Corey on Hoffstein at C Hoffstein, at Jason Buck. You're Jason at Jason Mutiny.
Yep.
Yeah. And follow at Blockworks _. Thank you, everyone. Thank you, Gory. Thank you, Jason, as always. And thank you, everyone, for watching.